Welcome to this explainer. Today, we're unpacking the thrilling, and yes, I do mean thrilling, mechanics of how companies actually raise capital and the incredibly rigorous rules for how they must account for it. Whether you're advising a startup aiming for the stars or a public company looking to scale, raising cash is really only half the battle. How that cash hits the balance sheet is what ultimately determines a company's financial destiny. Let's get into it.
Okay, let's just glance at our agenda. We are going to cover the traditional IPO process, alternative paths to going public, post-IPO raises, early-stage financing, and finally, we'll tackle the complexities of ASC 480 equity classification.
All right, Section 1, the IPO process. Let's talk about going public.
So this whole journey kicks off with the S-1 registration statement. You know, that massive document packed with audited financials and every risk factor under the sun. Then, you're stuck in this grueling 2 to 4 month SEC review period. But once the SEC finally declares it effective, it is go time. Management literally hits the road. During this roadshow, they're out there gauging institutional demand, building up an order book. And all of that culminates in pricing the stock the night before trading, leading to the actual listing on an exchange like the NYSE or NASDAQ.
But wait, here's your first major watch out. When the CEO's up there on the balcony, smiling and ringing that bell on listing day, they don't actually have the money yet. Seriously, settlement and the actual arrival of those net proceeds, minus the underwriter's cut, happens at closing. And that's 3 business days after the listing date. So you absolutely have to make sure your clients know they can't start spending that cash on day 1.
Moving on to Section 2, alternative paths, specifically direct listings and SPACs.
Now, if a traditional IPO doesn't sound appealing, companies have options. On one hand, you have a direct listing. This completely bypasses the underwriters. Existing shareholders just sell their shares directly to the public. It's way cheaper, but keep in mind, the company raises absolutely zero new capital. No new money coming in. On the flip side, we have a SPAC, or Special Purpose Acquisition Company. A SPAC is essentially a blank check shell company. It raises public cash first, and then it goes out hunting for a private company to merge with, a process we call a de-SPAC transaction. But what's absolutely vital to remember here is that SPAC investors have the right to redeem their shares and take their money back right before that merger closes. Talk about a built-in escape hatch, right?
Okay, Section 3, post-IPO raises. The company is public, but they need more capital.
There's a critical distinction here that the market constantly gets wrong. People throw around the term secondary offering all the time, but here is the actual truth. A primary offering issues brand new shares. The company gets the cash, and existing owners get diluted. A secondary offering simply means existing shareholders are selling the stock they already own. The company gets zero proceeds and no new shares are created. The golden rule here? Always ask, who is actually getting the check?
Now, when a public company wants to be ready to strike while the iron is hot, they use something called a shelf registration. If they've been public for at least 12 months, they can pre-register a massive block of shares with the SEC. Then, if market conditions suddenly become absolutely perfect, they can literally take those pre-approved shares off the shelf and raise money instantly in tranches. And the best part? They do this without restarting that whole agonizing SEC review process.
Alternatively, public companies can skip full SEC registration altogether by using private placements. They do this by relying on specific exemptions. For example, Rule 144A allows for the resale of restricted securities to qualified institutional buyers. We're talking massive institutions managing over $100 million. Then there's Regulation D, which is super common for selling to verified accredited investors. But honestly, the most intriguing one for public companies is the PIPE, private investment in public equity. This is a fast injection of cash, but to lure those private investors in, it usually comes at a discount to the current market price.
Which brings us to another major watch-out for advisors. That PIPE discount might be a wonderfully fast way to execute a capital raise, but it signals immediate economic dilution to the folks who already own the public stock. Because of this dynamic, depending on exchange rules, executing a PIPE might actually require shareholder approval before you can even pull the trigger.
All right, Section 4, early-stage finance. Let's rewind the clock and talk about funding the startup.
Early-stage financing basically boils down to 2 instruments. First, safe notes or simple agreements for future equity. These act as a deferred obligation. They are incredibly founder-friendly. No interest rate, no maturity date. They just seamlessly convert to equity at the next priced round. Convertible notes, on the other hand, well, they're strict debt instruments at issuance. They carry an interest rate, often paid in kind, and they have a hard repayment deadline.
a true maturity date if they fail to convert into equity.
And finally, Section 5 ASC 480 Equity Class. Let's dive into the preferred stock rules.
Because here is the big secret. Not all preferred stock actually belongs in the equity section of the balance sheet. Crazy, right? The crucial point in classifying preferred stock rests entirely on answering one single question. Who has the right to demand redemption? If you can answer that, you can completely conquer ASC 480.
So here is your ultimate cheat sheet for the three-way classification test. If the company is unconditionally obligated to redeem the stock at a fixed date, meaning they absolutely cannot avoid it, it's classified as a liability, plain and simple. Now, if the holder holds the power to demand redemption or if some outside contingent event can trigger it, that goes into temporary mezzanine equity, nestled right between liabilities and permanent equity. And finally, only if the company holds all the cards and has the sole option to redeem does it reach the holy grail of permanent equity.
Now, why does this matter in the real world? Well, venture-backed companies almost always carry mezzanine preferred stock. Why is that? Because venture capitalists absolutely love to negotiate escape hatches. They usually write in a clause saying that if an IPO or acquisition doesn't happen in, say, 5 to 7 years, they have the right to demand their money back. Because the investor controls that redemption right, it forces the stock right out of permanent equity and drops it straight into the mezzanine section.
And let me tell you, mezzanine equity comes with some heavy accounting baggage. We call it accretion. When the negotiated redemption price is higher than the initial cash received, we have to smoothly accrete that difference over time using the effective interest method. So, each period, you debit retained earnings and credit the mezzanine equity account. Basically, the carrying amount on the balance sheet steadily climbs up until it hits that final redemption price.
And here is your final and, honestly, perhaps most dangerous watch-out. Mezzanine accretion actually reduces the net income available to common shareholders when calculating earnings per share. But here's the kicker, the part that trips everyone up. It does not appear as an expense line on the income statement. Clients and financial statement users miss this hidden EPS trap constantly. As an advisor, it is your job to warn them before their EPS drops invisibly and everyone panics.
Eventually, though, the happy day arrives. The company goes public, and that mezzanine preferred stock automatically converts to common stock. When this happens, just follow the golden rule. No gain or loss is recognized on conversion. You simply take the full accreted carrying amount of the mezzanine preferred and transfer the whole shebang over to common stock and additional paid-in capital. It's literally just a reclassification, moving the balances permanently onto the permanent equity side of the board.
As we wrap up this explainer, I want to leave you with this thought to ponder. We've seen how PIPEs can dilute your founders, how a SPAC gives investors a last-minute ripcord, and how mezzanine preferred stock can silently assassinate your earnings per share. In the high-stakes game of company building, raising the cash is really only half the battle, right? Accounting for it correctly is what actually keeps you in the game. So, knowing these hidden traps and dilution risks, how will your next capital strategy permanently alter your balance sheet? Thanks for hanging out with me today, and stay focused out there.